Can we kick off with your credit losses? $268 million. It's the highest number in a decade. The reference point is that it's good quality in terms of the credit exposures that you have. Please guide the market in terms of how tough that could get for 2020. 268 million now. What do you think that could go to at the end of the year?
Well, first of all, let me point out that our credit losses during last quarter is the outcome of a strategy and a clear risk-reward priorities we put in place on how we manage the financial resources of the bank, and it's also reflecting a very effective way for us to manage risks on a short-term basis. And last but not least is also reflecting the fact that our business model sees a high degree of concentration in lending exposure in Switzerland and in general to asset-based lending, so where we have a high degree of underlying guarantees. Therefore, we can be relatively optimistic about the extent at which credit losses will impact our future. Of course, we're also going to be affected by that.
Now, in the announcement, you talked about recurring fee income, net interest income, and transaction-based income all under pressure. Is that going to come to bear on the numbers in the rest of the year?
Well, on recurring fees, it very much depends where asset levels will be, particularly equity markets. The starting point for Q2 is lower. As we indicated, we expect a contraction of around 250 million on net recurring fees. You saw that NII was stable, but of course, it's going to be challenging because lower rates will continue to dent our margins on the NII front. On the other hand, the fact that we are extending more loans is helping us to mitigate part of that. You see, on the other end, a more normalized environment in terms of transaction volumes, and we feel that the combination of all these factors, positive and negatives, in addition to the fact that we are continuing really to execute on our strategy, will help us to mitigate the negative effects. Now, our focus is really all about that, continue to perform while staying relevant to our clients and keeping our employees safe and healthy, so that they can continue to do a great job. Because eventually, when you look at the first quarter, you saw really UBS at its best, and really us being able to perform, across any dimensions.
Let's talk about the word that you used twice now. We spoke a couple of weeks ago. You said, Manus, we're doing more lending, more loans. Again, you're using that phrase again today. Where are you seeing the most uplift in lending? Is it on the IB side with credit to institutions, or is it on the wealth management side? And the geography, just a little bit more colour.
So we saw lending, we expanded lending by 15 billion across the board geographically, which is in addition to what we are doing in Switzerland, where we extended 2.5 billion in the government-backed programs, and we also made a commitment in the US for another 2 billion. We extended, as I said, 15 billion of extra lending across every geographies, across all businesses. In Switzerland, for example, we extended almost 2.6 billion of extra credit to Swiss companies, 1 billion of mortgages. In wealth management, we had an expansion of lending of around 4 billion, coming up to the end of the quarters. But it's quite interesting to see, for example, that in Asia in March, you saw some deleveraging. So the net number, it's all about the fact that some clients went risk on and off during the quarter. But across the board, we see lending demand is exactly what we are supposed to do and want to do at this time. to help clients to go through these difficult times, but also at the same time keeping our capital strengths, our discipline in how we manage risk, so that we can also protect the other side of the balance sheet, our depositors.
Indeed. Just talking about the clients, I looked at your survey. Near-term optimism collapses to 46%. Medium-term, 70% are optimistic, and 37% looking to investment. Where's the wealth management clients at the moment, Sergio? Are they scaling up their activity into this rally that we're seeing in equities and credit that we've talked about a couple of times? Just give me a sense of the momentum through the past month.
No, I think that if you look at in March, as I mentioned, we saw some deleveraging coming in March, and some asset allocation shift. At this stage, as I mentioned last time we spoke, we are still favoring, for example, more the credit side of the asset allocation. We believe that credit is offering a better risk-adjusted returns, and it's probably also more reflecting the true expectations on the macroeconomic environment for the foreseeable future compared to equities, where you still see some attractive opportunities on a single stock basis, but overall valuations are a little bit more stretched. So I would say that in general, clients are ready to deploy cash in a selective way, and but as they indicated, investors are waiting probably for the situation to clarify over the next couple of quarters.
Oftentimes, we josh and we talk about good volatility and bad volatility. Vol is obviously played to the equity business. I see the equity business is up by 18%. But what does volatility mean for the business and for clients? Are they clashing?
Well, in general, volatility at this stage is clearly maybe supporting clients engaging into the necessity of hedging or writing options and capturing options premium through structured products. But when you look at from an asset allocation standpoint of view, high volatility means also a lot of uncertainty. And as long as we have this very high level of volatility across all financial assets, it's very difficult for clients to really pose and think about long-term strategic asset allocations decisions. So overall, it's good to have volatility. Some volatility is healthy for markets, but on the other end, if you have too much volatility over time, it may pull clients off in terms of their investment decisions.
Is that pushing them towards cash, raising their cash balances? Are you actively, as a house in the CIO team, encouraging more cash and risk off?
No, I think that we are encouraging diversification. I think that we believe that, as I mentioned before, there are some interesting opportunities on how to deploy cash, particularly in the credit side of the equation, even when you look at high grade, investment grade, and but also in the high yield space, there are some good opportunities. So in general, yes, indeed, you see a little bit of people cashing in and deleveraging, but I wouldn't call it a meaningful change compared to what we have been seeing over the last few quarters.
Sergio, time is really short with this. Since we spoke, the Fed has begun to buy junk bonds. Is that good for markets or a risk? Briefly.
I think that I think that there is at this stage every possible solution has to be used in order to counter the effect of the crisis. But there is going to be a point in time in which maybe we need to rein back a little bit the situation, and because I potentially the market cannot get too used to those kind of intervention, and eventually we need more structural changes and reforms across the board, not only in the US, but I would say more generally in Europe in order to tackle the crisis.